Inventory is a big part of current asset. You do have, receivable, marketable security, cash, but inventory is particularly interesting because it tells you a story. I mean, of course, the others as well, but the story is much more straightforward. Like cash, cash is cash, right? So you don't really need to reevaluate cash. You would do it, by the way, with receivable, but inventory even more, because when a company says we have 500 million in inventory, the question is it really worth 500 million? Could be worth much more. Could it be worth less? And that question of how much is it worth is why inventory is so important. Now, under IFRS and US GAAP, there is the common idea that the inventory is tested at each reporting date and it's corrected lower, written down if needed. Now, IFRS allows you to bring it back up never more than its initial cost. US GAAP doesn't. And under IFRS, the formula is, as you can see here, the lower of cost and net realizable value. So the cost that you pay to acquire it or produce it, and the estimated selling price minus the cost to complete it, because sometimes the product is not finished, and to make the sale. So whatever is the lowest, right? This is, if you want, the value at which the inventory is recorded. Now, under US GAAP, you will see sometimes lower of cost or market, and market is basically replacement cost. But the idea is that even under US GAAP, it will not be higher than the net realizable value, and not lower, by the way, than the net realizable value minus profit margin. But for this intro, remember especially the net realizable value. So, important nuance again. When you write down the inventory, the loss goes to the income statement and generally into the cost of goods sold. You can, as we said, recover, and you're allowed to reverse the write down under IFRS up to the original cost maximum. But under US GAAP, you cannot. So US GAAP companies, the ones that are listed on the US stock exchange, are once the inventory is written down, it stays at the lower value. So there is a chance that many of those or several of those companies have an inventory that is below what could be realized, the real net realizable value. Anyway, remember that when you write down the inventory, you hit both the balance sheet with a lower inventory and the income statement, as we just said, the nuance for the COGS. So it has an impact on both, and therefore a change in inventory affects your margin, your return on assets, the inventory turnover has an effect on all those. And you have to look at the formula to see how it affects it.